Welcome to the Skilled MBA Finance Case Study Series, where we uncover real-world financial lessons shaping today's business landscape. China Evergrande's meteoric rise in the global real estate market was driven by aggressive expansion and strategic market capture. Yet beneath the surface lay deep-rooted financial misconduct, including inflated revenues and fraudulent practices. This corporate failure prompted regulatory intervention by the Hong Kong Securities and Futures Commission, highlighting not just regional but global implications of governance breakdowns. The Evergrande saga serves as a stark reminder of the vital importance of transparency, ethical leadership, and robust internal controls in sustaining financial integrity, essential takeaways for finance professionals and corporate leaders worldwide. China Evergrande's rise in the global real estate market was marked by aggressive expansion and strategic positioning. However, this growth was overshadowed by financial misconduct, including fraudulent practices and revenue inflation. The Hong Kong Securities and Futures Commission's actions highlighted significant regulatory challenges, offering crucial lessons in corporate governance and ethical leadership for finance professionals. Hengda Real Estate Group, part of China Evergrande, capitalized on China's real estate surge, becoming a key player. Listed in Hong Kong, it expanded rapidly, amassing over 2.4 trillion Chinese yuan in debt by mid-2023. This aggressive growth strategy prioritized expansion over financial stability, with projects in over 280 cities, symbolizing China's property boom. Founded in 1996 by Hui Kayan in Guangzhou, Evergrande's journey began as Hengda Real Estate. By 2009, it rebranded and raised $722 million United States dollars through a Hong Kong initial public offering. Between 2016 and 2019, the company aggressively diversified into sectors like electric vehicles and sports. However, by 2020, financial distress surfaced with missed bond payments. Evergrande's business model heavily depended on pre-sales, collecting advance payments from home buyers before construction. Their aggressive land acquisition strategy involved purchasing land at premium prices, often financed by high-interest debt. Additionally, their diversification into unrelated sectors lacked proper risk assessment and expertise, contributing to their financial instability. In August 2021, Evergrande first missed payments to suppliers and contractors. By December 2021, it officially defaulted on 19 billion United States dollars of international bonds. On January 29, 2024, the Hong Kong High Court ordered its liquidation. In March 2024, the China Securities Regulatory Commission imposed a 4.2 billion Chinese yuan fine on Hengda and 47 million Chinese yuan on Hui Kayan personally. The China Securities Regulatory Commission uncovered that Hengda Real Estate inflated its revenues by Chinese yuan 563.9 billion, equivalent to United States dollars 78 billion over 2 years. This revelation highlights significant discrepancies between reported and actual revenues, raising concerns about the integrity of financial reporting and the broader implications for stakeholders. Hengda Real Estate engaged in fraudulent financial practices, including fabricated pre-sales by recording revenue from non-existent customers. They manipulated project valuations through internal transactions and related party deals. Off-balance sheet debt was concealed using complex corporate structures and undisclosed guarantees. Additionally, false contracts were created to justify revenue recognition and asset valuations. PricewaterhouseCoopers, as Evergrande's auditor from fiscal year 2019 to mid-2021, issued unqualified opinions despite over Chinese yuan 563.9 billion in falsely reported revenue and discrepancies in cash flows. Inconsistent disclosures and implausible growth metrics were overlooked, questioning the effectiveness of external audits for complex multinationals. Corporate governance at Evergrande was severely compromised. Weak independent directors, closely tied to Chairman Hui Kaiyan, failed to provide adequate oversight. Risk management was ineffective, with committees unable to challenge unsustainable debt and aggressive growth. Opaque reporting practices obscured the true financial position, while a culture prioritizing growth over compliance enabled these failures. The China Securities Regulatory Commission imposed a record fine of 4.2 billion Chinese yuan on Hengda Real Estate and a personal penalty of 47 million Chinese yuan on Chairman Hui Kaiyan, alongside a lifetime market ban for key executives. Meanwhile, the Hong Kong Securities and Futures Commission is enhancing scrutiny of mainland-based listings and reviewing audit quality assurance mechanisms. Julia Leung, as Chief Executive Officer of Hong Kong's Securities and Futures Commission, is tasked with restoring market trust by enhancing investor confidence in regulatory frameworks. She aims to strengthen disclosure requirements for property developers and improve international coordination with global financial watchdogs to tackle cross-border enforcement challenges. Regulators must protect investors from fraudulent disclosures while ensuring Hong Kong remains competitive for mainland firms. Balancing political dynamics with mainland China is crucial, as is aligning with international standards, accommodating regional differences. This delicate act is essential for maintaining Hong Kong's financial hub status. Evergrande's debt surpasses $300 billion, impacting global creditors. Over 170 financial institutions face exposure, while United States $19 billion in foreign bonds default, affecting asset managers worldwide. Additionally, 1.5 million prepaid homes remain undelivered, creating significant challenges for home buyers and contributing to broader market instability. The Chinese property sector's contagion risks are multifaceted. Banks face increased non-performing loans, limiting lending capacity. Construction supply chains suffer from payment defaults, while bond markets see rising yields in corporate debt. Local governments experience reduced land sale revenues, affecting fiscal stability. Consumer confidence wanes, leading to declining property purchases and a diminished wealth effect. The Evergrande scandal has heightened scrutiny on the Big Four accounting firms in China and Hong Kong. Key concerns include auditor independence with politically connected clients, verification of revenue in pre-sale models, and cross-border audit coordination. This case underscores the expectation gap between user beliefs and auditing standards. Independent directors with expertise are crucial for challenging management. Evergrande's board failed to address unsustainable growth and debt. Risk management should be integral to strategy, yet Evergrande prioritized expansion over controls. Ethical conduct must be led from the top. Evergrande's culture focused on numbers, neglecting financial health. Finance professionals must prioritize ethical leadership and rigorous due diligence to prevent crises like Evergrande's. Regulatory compliance and transparency are crucial for sustainable growth. The Evergrande case highlights that growth based on fraudulent reporting and excessive leverage is unsustainable, leading to inevitable failure. A robust corporate governance framework could have enforced stricter oversight and accountability, potentially averting the Evergrande crisis. Specific audit procedures, like forensic audits, should have detected revenue inflation at Hengda Real Estate. Regulators must balance investor protection with market competitiveness by ensuring transparency. International investors must conduct thorough due diligence, especially in markets with varying disclosure standards. Evergrande's collapse highlights the critical need for robust governance and ethical leadership in business. As global finance observes Hong Kong and China's response, it underscores that oversight failure can be as damaging as financial risk. For further insights into corporate governance and financial ethics, explore our resources. Thank you for tuning in to the Skilled MBA Finance Case Study Series. Mobile plus 91-87553-00795. Email support@skilledmba.com. Website www.skilledmba.com.